Good morning, everyone. Thank you for joining us. This is Sally Carruthers of True Union, and you should be here for our third quarter webinar. And this is concerning traditional appraisal and a kind of concept that I've heard kind of passed around the appraisal profession. And the question really, whether it is doomed, how our business will likely change, and some of the issues that will change it. So basically analysis of the residential appraisal in a current market / mortgage environment. A couple of housekeeping items. You guys, as you come onto the call, are all muted, and that is really because we have a lot of people, and just so that we can run through this webinar without any interruption. At the end of the webinar, I will provide my contact information. Feel free to just send me an email with your comments, questions, or anything else. I have been kind of batting around an idea for about a year now, and we haven't actually done it, but having some kind of interactive coffee morning, or as I prefer, tea in the afternoon, with appraisers, so that we can discuss some of the issues that you guys are facing out there, and really have it interactive and do it via video, so that I can see you, and we can have a kind of face-to-face discussion. I really want to know how it is for you guys out there and what you're facing. So please kind of give me some input on whether you would like that. We have to somewhat control the numbers on it to make it work, and put some kind of rules in place about, if you've been on a Zoom call or a kind of video call, that it's hard if everybody wants to talk at the same time. So we'll do that, but I think that would be a good idea, and I would really like to do it and get talking to you guys face to face, rather than you just listening to my voice as I kind of go through a webinar. This webinar is, I'm going to kind of probably throw out some ideas. It is not really meant as an opinion necessarily of True Union, our company. It's really just kind of some ideas, issues that I see. So don't all yell at me or think that I know something that you don't. I don't know any more than you do. So it really is just kind of thinking about openly where things might go and what might happen. So let's move on to the webinar. Let's do a little bit of background about our traditional appraisal practice and how we perform. One other thing, I hope to do this in less than an hour and get you out in an hour. I should have said that right up front. So, but understand if you have to get off before. And I never know how, I kind of know how long these are going to last, but never really know. So hopefully we won't keep you for even an hour, I'm hoping. So let's, a bit of background. Everybody who will work in this, we know that our appraisal business is highly regulated. I'd say probably one of the most highly regulated professions there are. And it's somewhat understandable when you think about the fact that essentially each one of you are appraising or valuing millions of dollars of collateral every year, and millions and millions of dollars of collateral. And that's huge responsibility. And so it's not surprising that as appraisers, we are all regulated. We're licensed by the states. And there is a federal mandate, essentially, for our license. And those regulations, they don't just deal with our qualifications, but they also deal with our performance, because we are required to conform to USPAP, standards of professional appraisal practice and have an ethical standard that we have to follow. And that applies to you guys, the appraisers out in the field, but it also applies to us as an AMC. We are heavily regulated, and then our client credit unions are also heavily regulated. So right across the board, there is a lot of regulation and limitations around what we do. So the kind of essential thing, it's no surprise you guys understand that the original base minimum residential mortgage appraisal regulations came out of FIREA, the Financial Institutions Reform, Recovery, Enforcement Act of 1989, which really set that standard for appraisal licensing. And of course, that's a federal banking regulation that then told the states have they have to license people, the states how to license us. So essentially now we have a federal organization, which would be the appraisal subcommittee, that really oversees the states on how the qualifications and standards for appraisers, and also for AMCs too, so that are regulated too by the states. So that deals with qualifications, but also states that, so basically any mortgage transaction has to be completed by a licensed certified appraiser and has to conform to USPAP, the Uniform Standards of Professional Appraisal Practice. That is the base minimum. And of course, we do know there is a de minimis. We'll talk about that in a little while. That's up to $400,000 now. And then on top of those base regulations, there are various guidelines, such as Fannie Mae guidelines and FHA guidelines and interagency and all kinds of things that basically are controlling in some ways the scope of our residential appraisal. And so with all that regulation, then on top of that, we've got the clients and intended users. So we work for credit unions, so they are monitored by NCUA. So we fall under that too. So why I talk about this is that we all wonder what is going to happen to our traditional appraisal, form, report, whatever. But it takes a mountain almost to just move all these regulations and guidelines and requirements and all kinds of things to get any change. And so I think what happens is that change becomes piecemeal. We all kind of think, oh my gosh, something really grand is going to happen, when in fact, often it doesn't. It just, USPAP has changed a little bit every couple of years. Guidelines are updated, and we still struggle along with the URAR from 2005. And so what that is because of that framework that we work under. So it's good and bad. There are good and bad things about that. So, but I wanted to put that out there just so everybody has that base understanding. So what is the current mortgage environment? My gosh, regulations. And just so everybody understands, I'm only going to talk about appraising for mortgage purposes right now. Basically because, I own an AMC that works with credit unions. So that's a mortgage experience. You guys obviously probably do other work out there for non-mortgage clients. Of course, I would encourage that. So, but let's talk about the mortgage environment out there. When do we kind of get engaged as appraisers to perform? So, of course, the big one, standing right up there are Fannie Mae and Freddie Mac. Majority of residential mortgages are really sold to these secondary market participants. And with that, they really do hold the cards on how we perform our appraisals and really, I guess, frame exactly what happens in a traditional appraisal assignment. So Fannie and Freddie are huge. With them, FHA, VA, USDA, they tend to follow kind of the Fannie Mae format, the set forms, and use those forms, but with additional guidelines and requirements. We then have something that falls outside of that Fannie Mae, Freddie Mac thing, FHA. We have interagency and federal-related financial transactions that fall under the interagency guidelines of 2010. And those would be situations where a credit union would not sell a mortgage to Fannie or Freddie, or not have that mortgage insured by FHA, or not guaranteed by VA. So they would be essentially portfolioing that mortgage. Now, oftentimes when our credit union clients actually portfolio or keep that mortgage in-house, they still underwrite the Fannie Mae guidelines. So you're still required to follow those guidelines, even though they're not actually selling that loan. Also, many of our credit union clients are offering jumbo loans. Many of you are appraising some pretty high-value properties out there. Again, they tend to follow that Fannie and Freddie kind of guidelines, essentially. Although there have to be some parameters that maybe you need to explain, because you go beyond some of the limitations of those guidelines. Credit union clients do HELOCs, home equity lines of credit, a lot of those, and you will see that often when they are offering a line of credit, because the risk is less, the amount of money is less in lending, they will have a more limited scope appraisal, a drive-by maybe, or a shorter form, maybe they use AVMs. You don't even know that they do. That's kind of, they fall outside of the conventional kind of secondary market guidelines and FHA. And then, unfortunately, our credit unions do foreclose on properties, and they have to have default appraisals or valuations of some form during the process of that when a property falls into default or the process of foreclosure. So I think those are the main. There are some other kind of mortgage type assignments that you might get, some portfolio management type of things, and some other items. But these are the main this is the main crux of the mortgage environment. So we talked about Fannie Mae and Freddie Mac, and kind of building on this kind of history of what we do. And back in 2010, Fannie Mae and Freddie Mac introduced collateral underwriter, and I think it's kind of had a huge kind of impact on what we do. Of course, it has impacted the way that you complete your URAR 1004, 1073, or whatever it is, because you have to complete it in a UAD format with certain things. It also means that all your appraisals tend to get delivered into the UCDP portal, and they're scrubbed and they're compared to everybody, all the millions of other appraisals that go in. And there is a risk score that comes out of them, and obviously Fannie and Freddie are able to make some certain decisions based on that risk score. For example, if somebody applies for a mortgage and there's already been an appraisal on a property and it had a low risk score, that for the new assignment they may be able to get an appraisal waiver. I have a feeling right now that because of COVID, there are probably more appraisal waivers. The last I heard, I think it stood at less than 10%. But I know many of our credit union clients are trying to, obviously try to get those to save money. big thing to remember about appraisal waivers, an appraisal waiver can only be successful if there's data to satisfy the risk. And so who drives that data? Well, you guys drive that data. Every day you do an appraisal, and every day that appraisal report goes into the UCDP portal. There is information in that database, and that can be scrubbed and looked at and compared to others, so that the model can tell if markets are going up, going down, if adjustments are accurate, even obviously if you've used a different condition rating, all kinds of things can be compared, one property against another, and really provide some kind of risk score on your appraisal and help a credit union to underwrite that loan. So it is quite surprising. We do see, as an AMC, we don't have access to collateral underwriter, and obviously you don't have access to collateral underwriter, which I think is rather unfortunate, but we'll talk a little bit about that again. But we do get the SSR score, and I am continually amazed at mostly how accurate they are, but sometimes some of the flags that come up on appraisal reports that I wouldn't have imagined. But generally, so to speak, are really, I think most of you guys are doing a great job. And on average, I think the credit union will get what's called day one certainty on anything that's 23 and below. I think I'm right. 2.3 and below. I think I'm right in that. And the vast majority of what we get from you guys, I would say, I think it's up to 80% of the files, the appraisal files you deliver, are in that low risk thing. Could also be that you're doing low risk properties, but I think that's actually a really good thing, because often credit unions service some kind of rural properties and some difficult areas. So I think it's really good that our appraisers are doing such a fantastic job on this. So the big one, COVID-19, this has kind of rocked all our boats, right? Incredibly. It has made your job much, much harder and put you on the front lines. Put you on the front lines earlier this year as essential workers. I'm incredibly proud of our appraisers out there continually working under difficult circumstances, and being able to keep the real estate markets running effectively and efficiently. So, kudos to you guys. It's absolutely amazing. But this has really, really impacted a lot of things, and kind of interesting enough that this is as I kind of said earlier, our third quarter webinar, and our last quarter webinar, our second quarter webinar, we actually did very early in the quarter. We did it right after basically the lockdown from COVID, and it was to do with the coronavirus and what impact that was going to have you guys appraising in a pandemic. And I looked at my notes this morning, and I think when I first started to write that webinar, the world limit, the world infections was something like 335,000. So I don't know what it's up to today, but that's really such a fraction of what we have right now. And we are living in a very, very different world to what we were 6 months ago. And you guys are working in a very, very different world to what you were 6 months ago. And I think kind of throws out somewhat, or has thrown a wrench into our idea of a traditional appraisal report. The first thing I really want to talk about on COVID probably has nothing to do with necessarily your that traditional appraisal, but what to ensure, as always, that you guys stay safe and that you're utilizing all the things that you have to do to stay safe, and on the clear understanding that sometimes you will not want to go into a property, and sometimes you should not go into a property, and sometimes you should not be in contact with homeowners or realtors or anybody else, depending on where you are, as far as health and various other aspects. So we will always respect that. I hope that we have done over the last 6 months, and would really like to know if we haven't. And I know our clients respect that. And of course, there are options if you cannot do that inspection. But the other side of this that we didn't know 6 months ago, when we had a good idea as we started to lock down, was the impact on the economy of this virus. And I don't think we have seen this yet in our real estate markets. I haven't seen it yet in any of the markets we serve, but it is bound to happen at some point. Right now, unemployment rolls around 10%, something like that. Many small businesses being kept alive with PPP loans, and we have some really kind of bad situations. We have kind of a false hope sitting there. I think someone, again, this is my opinion, you might not agree with it, but I think we have a false hope sitting there with the stock market that's really being fueled by the tech industry that's doing obviously very well. Apple, Amazon, those kind of people. And then you got an economy that really is struggling. And so at some point that is bound to have an impact. I think that Fannie and Freddie did a really great job coming out with some temporary requirements, and kind of, of course, this really did hit when interest rates were phenomenally low, and still, kind of floating around that 3% level. But those Fannie and Freddie kind of temporary requirements are somewhat limited. As we have found out, and as our credit union clients have found out. We will talk about those a little bit, but basically, it does apply to some purchases. It applies to a very limited amount of refinance. It's basically if they are still holding the loan. To get some relief out there is somewhat difficult. And really, I think very small, kind of probably about maybe less than 5% of what we're doing really is utilizing those temporary requirements, or maybe about 5%. At the moment, we have this interesting thing. We do have, a recession. There is a recession, but we still have very, very strong demand in our markets, in most markets, because of low interest rates and I think a lot of pent-up demand. And then with that, we have limited supply. I think that we've got a lot of people coming into the real estate market, a lot of first-time buyers, and then a lot of people not wanting to sell. They don't want to move. And so you're seeing a big surge in new construction to try and keep up with that. And again, I think, that really resulted from some pent-up demand that has been going on so long, and long periods following the last Great Recession when there was no new construction. And there is this kind of concept of a flight to suburbia. If anything, the COVID-19 thing has kind of shed a light on some of the fears of living in urban areas, although a lot of our growth have been in urban areas over the last few years. So these are some kind of concepts out there that I think we should be considering and looking at and beginning to really see. So let's, as we're talking about our traditional appraisal report and how that might be changing, I think that the big impetus maybe towards change was the introduction of these temporary COVID guidelines by Fannie Mae and Freddie Mac. And I think they introduced a couple of concepts that I think may be staying. and that we as appraisers probably, especially those of us who've been doing it a very long time, it's difficult to knock this out of us. And the first one I kind of really have tacked on here is the removal in the new COVID guidelines, that expanded scope and limiting conditions and certification. The modified one that comes is the removal of certification number 10. And it basically is, I verified from a disinterested source all information in this report that was provided by parties who have a financial interest in the sale or financing the subject property. So this is basically where we kind of originally we'd always have to look for a verification source, right? And if seller's agent provided us with comps, we need to verify that ourselves, or if the borrower provided something, it's there. We have to find that disinterested source to verify our data. And that's been removed in the new COVID guidelines. And the reason being is that we are now going to allow an interested party, potentially, to provide us with data. So we're going to look at listing data, and the realtor and rely on them for information on the subject property if we don't make our own personal inspection. The same with the borrower. The borrower may be providing some data, pictures, video, whatever it is, walk around with FaceTime to show us the interior of the property, and we're not having someone coming in to verify that data is correct. And that actually is kind of okay under current kind of circumstances. We are able to kind of geocode where somebody is, if a borrower takes a video or FaceTimes you around their house, you can have a proof that it is actually their house. You can talk to them as they're doing it and say, raise it up to the ceiling, show me the floor, show me the kitchen cabinets, whatever it is. Because of the technology that we have now, we are able to create almost, I'm going to talk about this, almost an interactive kind of inspection. And so it's not just saying, hey, I'm going to drive by your house, and we're going to talk about that assumption. I'm going to assume that the inside is the same as the outside. We're actually, by the removing that certification number 10, we're actually essentially getting inside the house, but we're not making a personal inspection. We're having someone else do that for us. And we can be interactive and part of that inspection. So I think this is a really interesting concept as we start to look at this traditional appraisal, that we've always done, where I'm going to talk about inspection. We went in and we inspected it, and we measured it, and all this kind of stuff. Now we could have, and do have, homeowners or realtors or whoever it is being part of our appraisal process and providing the information on the physical characteristics of a property. And I think that obviously we use our due diligence, but it becomes more of an interactive thing. And I think that concept got really pushed forward with these temporary COVID guidelines. So the other thing is, and I think when they first came out, I don't think anyone realized this, is that under these guidelines, an appraiser cannot rely on that assumption anymore, especially the extraordinary assumption, which is, if anybody wants that same definition, extraordinary assumption is an assignment-specific assumption as of the effective date regarding uncertain information used in an analysis which, if found to be false, could alter the appraiser's opinions or conclusions. So, traditionally, as we used to do a drive-by report, we've been doing them for years. right? We drive up, and we probably would park out on the road. We might get out of our car or may not. Take a picture of the front of the house, take a picture of the street, go back, complete our report and say, hey, we see the outside of the property and we are making an assumption that the interior is in a similar condition or is, meets the outside. And hey, if that was found not to be the case, all bets are off. We're not certifying our appraisal. So what these COVID guidelines is, no, you don't get off that easily. That you're getting off scot-free by doing that. You have to use your due diligence in order to get information on the interior of that property. And it's up to you to use your due diligence on how you're going to do that. So are you going to discuss this with the property owner and have them FaceTime around the property? Or are you going to have them, we use a report from Collateral Analytics Scout report, which allows them to complete pictures and geocodes that inspection onto an app. Or are you going to use the realtor's listing and all that information they have provided? And then you're going to notate that in your appraisal report. My interior information is based upon a FaceTime video I had with the homeowner, Mrs. Smith, on this date, and I'm keeping that in my appraisal file if anybody ever asks about it, because my assignment results result from that confirmation of the physical characteristics of the property. And that's very different. This is a whole different thing that we have never actually had before. So I think it's very interesting because, as I said, I think that traditional appraisal now becomes interactive. Many of my colleagues have laughed at me for several years because I have said that there will be drones doing appraisal inspections. And in fact, that does happen. So and I know that many of the counties are using it for tax valuations. So I think it's kind of an interesting concept, but technology really starts to get into what we do. So what is a traditional appraisal report of 2020? Well, let's start with what it was of January 2020, because this has been a very odd year. It is a UAD compliant 1004, 1073, or any of the other numbers that you want to put forward. We usually think of a traditional appraisal as full interior and exterior inspection by the appraiser. So you are going out there. You are going to inspect the interior of the property and the outside, and you're going to take lots of photos, right? Photos. And I've got to say that many times appraisers are so, I got to get a photo of this, I got to get a photo of that. And reviewing these, I'm thinking, well, that's a nice picture of the sofa. That's a nice picture of the commode. But sometimes people aren't thinking, this is supposed to be a picture of the interior of the property. It's actually supposed to be a picture of the room, not the sink, not the ceiling fan or whatever it is. So it is documented that inspection, observation, whatever we want to call it, has to be documented with photos. We will provide a sketch, right, based on appraiser measurements. You're going to actually measure the property, however you do that, whether you use a old-fashioned tape measure, which I don't eventually do anymore, but you're going to measure it, and you're going to do a sketch. Going to show the location of the rooms, and show where the garage is, and the porch is, and then you're going to have all kinds of other documents. You're going to maybe take pictures of comparable sales, maybe. You're supposed to at least inspect them, add other maps. So this is what we think of as a traditional residential appraisal in 2020. It's usually on a URL or a comparable report for a whatever property is, a condo, a co-op, whatever. It is usually in a UAD format. It will usually be submitted to Fannie or Freddie or even FHA through a portal. It will include a bunch of documentation about the inspection, the observation. It should include some analysis too, and that is something I think that probably we're missing. We spend too much time on this inspection and a little less time on the analysis. So, and particularly not necessary, and this is kind of, it's not necessarily the analysis of the comparable sales, although I will talk about that a little, but I think of the market and what is happening, and looking at inventory levels, and how many times do I look at an appraisal on the first page, stable market, 3 to 6 months marketing time, and then I look at the comps and they all sold in 3 days. That is not a stable market. And demand and supply are not in balance at that point. So you've got to be very careful of cloning these reports and putting the same old thing in them. So what are the alternatives to this traditional appraisal report? Well, there are several, and some of them you can do and you can be part of, and some of them will probably be carried out by somebody else. And some of them won't necessarily fit into our traditional mortgage, first mortgage kind of characterization. So we have evaluations, and we'll talk about those a little bit. AVMs, BPO, AVMs is automatic valuation model. BPOs, broker price opinions, CMAs, which are kind of similar to that. We have hybrid appraisals, drive-by appraisals, and desktops. So those are some of the alternatives. Let's talk about evaluations. For those of you who also work on the commercial side, you're probably a little more familiar with evaluations. I think that these are going to we're going to start seeing these more and more on the residential side. So for the Dictionary of Real Estate 6th edition, an evaluation is a valuation permitted by the appraisal regulations of the Federal Financial Institutions Examination Council, that's FFIEC, agencies for transactions that qualify for the appraisal threshold exemption, business loan exemption, or subsequent transaction exemption. And currently, that threshold exemption is $400,000. So basically, let's take out Fannie and Freddie. Let's look at credit unions that are not going to sell their mortgages. And so they will fall under the governance of FFIEC. These are the examining board for credit unions that, I said it the other day, I just forgot it, but that's the credit union, anyway. But they will, NCUA, that's right there. So, but they will fall under that requirement. And so, on the transactions at less than $400,000, they don't necessarily have to have an appraisal. They could have an evaluation. So an evaluation does not have to be completed by an appraiser. Often on the commercial side, it may be done by an employee of the credit union. It's not required to conform to USPAT. But since the purpose of an evaluation is to provide a market value opinion, an evaluation would fall under USPAT if performed by an appraiser. There is no prohibition of an appraiser completing a value assignment that is USPAT compliant. I know that's all very complicated. The thing is that it's kind of important to understand exactly what is in an evaluation. And, you have to identify the location of property, provide a description of the property, current use, projected use, provide an estimate of market value in its actual physical condition and under the current zoning, describe methods that were used to confirm the physical condition and extent of inspection, analysis describe the analysis performed, any supplemental information, and sources of information. Wow, information on the prepared. What does it sound like? It sounds like an appraisal to me, doesn't it? And they are. I mean, but what they are usually limited scope. We don't have to turn in, 50 pages of analysis to come up with a value. And often cases, appraisers are losing work because they're not doing evaluations. So simply, it's pretty simple to make it conform to USPAP and, put all those things into place that you need to make, if it's market value, you've got to consider highest and best use, to include assigned certification, exposure time, all the things you have to do in order to make an appraisal. But it still could be a limited scope appraisal. So I think that we will start to see these evaluations. There are some states that kind of have carved out exceptions for appraisers to be able to do that. I think it's California, and there may be another one, and not have to conform to USPAP. But, in most states, you're going to have to conform to USPAP. And so add whatever, include, and perform in the manner that you're supposed to as an appraiser. Now, this is the one that we hear a lot about, the hybrid valuation product. So most commonly, this refers to kind of a combination of property inspection by a non-appraiser with a valuation expertise of an appraiser. So a non-appraiser goes out, completes either an exterior or interior site inspection, takes photos, and produces usually some form of property condition report, which details the condition, the physical characteristics, and any observed positive, negative influences and conformity to market. The important thing is that if an appraiser does one of these, so you sit at your desk and you provide a hybrid valuation product, you use the information coming from a property inspector, you still have to have geographic competence. I think there was an expectation by some lenders that, hey, this is going to be really good. We can have, an appraiser sitting in, Boston, Massachusetts, and that appraiser is we're going to have inspectors all over the country doing these inspections, and that one appraiser is going to just churn out appraisal reports based on those inspections. It doesn't work like that. We have something called a competency requirement in USPAP, and so part of that is geographic competence. We are also licensed, certified in different states. So no, that cannot happen. So, and so I think, the ideas of this were great. I think I can see some benefits to this, but in the end, you still got to find appraisers to do it, and then you got to find appraisers who want to rely on that inspection. And while appraisers still have the option for traditional appraisal reports, I think it can be tough to get them to do this. Although, I think that there are many people who can. There is something that's kind of called a tie-out, and I've seen this used. It was used a lot during the Great Recession with the big default foreclosure market, and it's kind of where an appraiser sits at a desk and produces an appraisal based on a combination of valuations. Some of the big lenders did it on the default side. So that appraiser would have an AVN, DPO, traditional appraisal, and they would come up with, a value opinion based on those. I don't see it used much outside of the default world. And I think right now it's not a major thing. So the desktop. So we can move to a desktop. What's the difference between that and a hybrid? Well, not much, except that there's no personal inspection by the appraiser. And, this is the one where you may be using, and this is used in that under the temporary guidelines, you may be using that FaceTime video from the homeowner to get the interior inspection. And there are right now the temporary guidelines allow for desktop appraisals in certain circumstances. They are still completed on the 1004. Just type in that text desktop under the map reference section and, you know, include photos from homeowner or whoever it is. And I think this probably is kind of the logical successor to the drive-by or exterior appraisal. I think you're going to see more desktop appraisals. In fact, I think that Fannie and Freddie have just come out with some new forms that they have in the software that is being tried out in various cases. But the reports aren't that much different to our traditional appraisal reports. It's just that there is no inspection by the appraiser. So let's go to the big thing that I think that I'm seeing with this kind of movement away from the traditional appraisal, and I think it's this inspection. And I think this is really the hardest thing for appraisers to give up. So why do we inspect a property? Well, to gather information about the characteristics of the property that are relevant to the value. And USPAP is pretty, explains, talks about an inspection, and it all comes under, if you read Advisory Opinion 2. So what they say is that while there are other ways to gather information on subject properties, relevant characteristics, in many cases, the personal observation of the appraiser are the primary source of information regarding that property. So that's why it's inspected, because it's your eyes and you see the property. That's primary. You're not getting it from a secondary source. You're not getting it from the realtor or the homeowner. You're actually getting it yourself. You're seeing it with your own eyes. But I should only really hope that everybody knows that an inspection is not required by USPAP, but one is often conducted. And of course, you all know that an appraisal report must contain a signed certification indicating whether the appraiser has personally inspected the property or not. And also, there must be sufficient information to enable the intended users to understand the extent of the inspection performed. So, this inspection, it is kind of a major thing. So let's break that apart, because I know I've been in the field myself for many years. I've been appraising for many years, and understand that a lot of what, as appraisers, what we feel we do is this inspection. But let's ask some questions. Why are we making the inspection? Is it because we want that primary data? We want to be the ones that see the house ourselves. We see the land we're appraising. Are we walking that land? Are we really looking at that house? And when we say we want it as primary data, what kind of expertise do we need to do that? I can look at a roof from the ground level. I don't know if it's in good condition. I can tell if it's leaking or not. But I'm not a home inspector. I'm not a structural engineer. So what level of expertise do we need? And then this thing that we've gone into over the last few years is just taking photos. I mean, gosh, when I was appraising, we took a picture of the front, the back, the street. That was it. We didn't take interior photos. Then they kind of moved to doing the kitchen, remember this, and the bedrooms. And then all of a sudden now we're taking every single room in the house. And I would really argue, and I hear this from borrowers. They say, well, the appraiser was in my house for 5 minutes, which you always hear, usually they're complaining about the value. But, and they just took photos. Are appraisers really, really looking at a property when they've got their cell phone or camera, taking photos? I mean, I can remember as a parent when my kids played sports, I could never do the video thing because I couldn't actually watch them doing the sport. So do we kind of forget to really look at a property or really do that primary kind of data collection when we're just snapping photos? And then big question, do you take original photos of comps? Well, you sign that certification to say you drove past them. But is it really necessary? I mean, why are you taking it? I mean, this property sold, 6 months ago. It looks completely different. Well, arguably, you want to know the location, but don't you have an aerial map? It's not just a waste of time, really. I'm not putting an opinion out there, but I'm not quite sure. Are we really, with this whole level of inspection and the amount of photographs and taking com photos, how much of the fee that I pay you guys is going to drive around in your car and go from one property to another and take com photos and when you think about it like that, and what I really am concerned at is the analysis, the actual value opinion. So do we put far too much time into performing the inspection? Never mind you guys who live in rural areas and you're driving all over the place, and not enough time into our actual analysis. And don't all kind of get mad at me. This is just some thoughts on this. And again, what is the importance of that primary data? And with it, I kind of also think, what is the thing of it, independence and bias, if we do have somebody else doing that inspection? How do we actually police that person if we have an individual inspector doing that inspection? How are we policing them? Are they licensed? What are their credentials? What is their expertise? And then to measure or not. Are we replicating in the market? One of the things I really think that appraisers need to start looking at are, in much more detail, price per square foot. People buy property based on price per square foot. Very little analysis is done in residential appraising on price per square foot, done on the commercial side. So is it really necessary, to measure that house? Because you're not measuring your comps. Just some thoughts there. I'm not saying that you shouldn't measure the property, by the way, you should be, but just putting out plain devil's advocate. So, with that, is the URAR out of date? I don't know. I think that there are certain parts of it that are out of date. I think when we introduced UAD, we kind of jerry-rigged it a little bit to pop that in there. I think that there is a ton of verbiage that is not needed in appraisal reports, and especially a lot of the boilerplate that goes in. And I think we just don't need that in there. If you look at an appraisal report that is done for a client and intended users, there has to be enough there to clarify and understand the development of that appraisal, but we don't have to provide pages upon pages of boilerplate stuff that just isn't there. I think the bit that we're really, really bad at, and we don't really look at, are market conditions. I don't think there are details in there enough about the market analysis and truly looking at markets and inventory levels and demand and supply and marketing times and really arriving at a very realistic exposure time. The exposure time is the thing that sets or it's the foundation for your value. And if you don't have a correct exposure time, it undermines the credibility of that value. So yes, I do think that we could do with a page of market conditions, and I don't mean a 1004 MC, but there is a way that we could be better on that. I think that there could be some changes to the sales comparison grid. I am not sure that we need all the elements of comparison, the amount of adjustments. I just look at all that Okay, I'm just going to say crap about the basement, and the percentage completed and the rooms in there and all the adjustments I see just in that below grade stuff, and I'm not sure that's necessary, and I think that we could change that, and I really do think that we need to be looking at reconciliations based on price per square foot, and because I know that's how the markets look at it, how buyers look at it, and especially when you get into new construction. I think it's a really important part of it. So, there are some other things to look at. With that, I have to just talk about AMCs, because I think there has been, with the evolution of appraisal practice, there has been an evolution of AMCs. I think that originally when AMCs were created as a result of, for appraiser independence, HBCC, which became Dodd-Frank, I think you just had a bunch of these title companies trying to be appraisal companies. And then you had, they really didn't want to pay a decent fee. They just wanted to make a profit on the back of appraisers. And I think there has been an evolution to really decent AMCs that are really active and not reactive participants, that have a good relationship with appraisers. And, in our case, we're for-profit institution, but we're not going to make a profit on the back of appraisers. We don't have to. We provide a service, and we should be paid for that service as far as valuation management, and ensuring appraiser independence. At the same time, we have to ensure that we want to ensure that you guys are paid not just a customary and reasonable fee, but you're paid well and you're paid quickly, and because that's when you perform best. So that's really important, and create business opportunities for you. But at the other side, we have to be cognizant that we can't, we have people buying houses and refinancing houses, and they don't want to pay exorbitant amounts for appraisals. So there's kind of a balance there. But I think technology has helped a lot of us, and I think that you see AMCs very involved in that technology. So the future, just about run out of time. I think you're going to see more desktop. I think you'll see desktop appraisals. I'm not sure about the hybrid appraisals. I just don't understand the need to have these inspectors who we don't know who they are doing them. I think you will see collaborative appraisal reports. That's essentially where you get rid of that certification number 10, and you have homeowners and realtors and whatever providing some kind of assistance in providing information on the property. You're going to see less of the inspection time. The inspection time is going to come down. And it's really, I think it's important because it provides more opportunity for you guys. Less time in the field, more time on analysis, more time on providing that credible value opinion, being able to use other alternatives. We will see increased use of technology. Going back to that collaborative, interactive appraisal report, I think we're going to see some input of data out of collateral underwriter into an appraisal report. I think that you will see if you input data, you input sales and you're missing a sale, I think you probably get something that comes back at you and tells you are. So I think there'll be some kind of interaction there. And I do think that there will be a risk-based scope. We already do this somewhat, but I think you'll see it more on the first mortgage side. The realization that there's no one-size-fits-all traditional appraisal report. And hopefully with that, a lot more opportunity for all of us. And so I don't think there's going to be anything major right now, but I think things will change, and we just have to wait and see what that is and be receptive to it. So with that, I have been talking for right about an hour. So this is my email address. Please send me an email. I love getting emails from appraisers. I'd like your ideas about having a coffee morning or afternoon tea. I'd really like to talk to you guys face to face instead of having me just standing here or sitting here talking to you. But I'd like to know what your thoughts are on this traditional appraisal business. This webinar will also be offered on Thursday afternoon. I usually change up what I say, but you don't have to if you don't want to come back. But it will be the same basic thing. So thank you so much for joining us today. I really appreciate it. And please be safe out there. And thank you for everything that you do for us. And that concludes our webinar.